Michael Gomez, and I'm a real estate broker and an investor here in Nashville, Tennessee.
And I'm Seth Mosley, Grammy Award-winning songwriter and real estate investor.
We host a monthly meetup in Middle Tennessee for anyone who wants to build passive income, not only for retirement, but for today.
On the first Wednesday of every month, we bring in an expert from every area of investing to help you with things like finding deals, getting your financing locked in, asset protection, every kind of investing, so much more.
Our videos are all about delivering that content to you.
Go to musicandmoneyig.com for more info on our free monthly events. Hit subscribe on the page so you don't miss any awesome content, and hit that like button if you like it.
Don't let all the flair of my jacket distract you.
Here's the content.
Okay, so today we have a very interesting speaker. You know, we were having a conversation earlier on, and we're talking about how once a week, at least I have one of my clients that say to me, okay, so, you know, the downturn is coming, or the next recession, and I always reply the same way. I say, okay, well, what are the signs? I mean, do you have anything? You say, well, we're due for a downturn. And I say, okay, well, you got anything else? You know, anything that you've seen, any signs, interest rate going up, or robo loans, everybody's getting approved, and we got this adjustment, or anything. No, we're done. No, we're just due for a recession. And I'm like, oh my gosh. So anyways, I always reply, I don't think there's a switch that's going to be like on and off, and then before you know, we're in a recession, but that's just me. However, at the same time, I think that it is always very wise to be able to learn about, hey, what happens. You know, what do we do if it does happen, all those things? How do we invest in times of uncertainty, which times are uncertain? So our dear friend, Brendan Whelan, there you go, I got it. He's going to come and share with us this morning. So please give him a great Franklin, Tennessee, Nashville welcome. Let me get your... Okay, so let me tell a little bit about you, because I don't know, I need like more coffee, like way more. So Brandon used to live in Italy for 4 or 5 years, working for a nonprofit. And then he worked for Clayton Homes, which are the biggest manufacturer of mobile homes in the country. And then now you are Investors Relations and at Four Peaks. I don't know if you guys remember Andrew, Illinois. We had him here. He was one of our first speakers, and we were all blown away with how easy it is to actually invest on mobile homes, and how it's not supposed to be scary or like uncertain, but just like it's sharp easy. So now, yes, please put it together for Brendan Whelan. Thank you.
Awesome. Thank you very much.
And now I gotta find your stuff here.
Awesome. How's everyone doing this morning? Doing well? Awesome. Great. Well, perfect. So yeah, we're going to talk a little bit this morning about how to invest in times of economic uncertainty. Just to kind of touch on our company a little bit, Four Peaks Capital Partners, we started business as a company about 6 years ago now, and we are a fully integrated private equity firm specifically focused on investment in the commercial real estate space, specifically mobile home parks. We love the asset class. We've had a lot of really great deals over the last few years, and we'll get into talking more specifics about the space, and we can answer some questions at the end related to investment in that particular asset class. But before we get into all that, I want to talk a little bit about what's going on in today's economic environment. So I'm sure everyone's been following the news cycle recently. Over the last 3 to 4 weeks. It's funny. Seth approached us probably about 2-3 months ago, planning out for us to come out and give this presentation. And at that point, we were trying to decide what we wanted to talk about, whether we would focus specifically on the asset class, whether we'd talk about something a little bit more generalized. And unfortunately, the topic that came out of it was how to invest in times of economic uncertainty. And it's something that's unfortunately painfully relevant, in the last few weeks. The Dow plunges 760 points. Closes 390 points lower. It seems like, every time, whether you like the guy or you don't, Trump tweets out something, the Dow's up 800 points. The next day he tweets something else and it's down 700 points. So the reality is, that although we're not in a recession yet, we are definitely in times of economic uncertainty. So let's take a look at some of the current market conditions. Right now, the stock market is extremely volatile, to say the least. It's in an inverted yield curve, meaning that the yield that you're getting on the returns over the entire Dow are much lower than what is typical. Right now, we're actually down more than 7% from 2019 highs, and actually a lot of economists out there are saying that based on all the numbers, we have the potential for another widespread sell-off similar to what happened at the end of 2018, which I'm sure many of you remember. That sell-off resulted in the Dow being down almost 11 points, or rather 11% on the year. Another interesting stat that came out just recently is that there's an increase in bankruptcies. In July, it came out that there was a 5% increase in total bankruptcies throughout the U.S., which is very concerning. And finally, probably the most telling of kind of all the data out there is the 10-year Treasury. So as I'm sure many people know, the 10-year Treasury is kind of the benchmark for how well the economy is doing in the United States. So right now, the 10-year Treasury yield is at an all-time low. But really, kind of the most telling piece of data with regards to the Treasury bond is the spread between the 2-year and 10-year Treasury is below zero, which this has been kind of floating throughout the news cycle over the last couple weeks, but this has happened every single, or leading up to every single recession over the past 7 recessions. And so that's, while it's not something that can indicate, that the recession is going to start tomorrow, it's definitely something that is very telling of today's economic environment. So what is a recession? A recession is essentially defined as a significant decline in the economic activity spread across the economy lasting more than a few months. This is evident in real GDP, real income, employment, industrial production, and wholesale retail sales. Now, in the United States, this is more concretely defined as a decrease in real GDP over a 2 consecutive quarter period. So, how does a recession impact investors? What are we looking for? How do you invest during times of recession? Well, first and foremost, let's talk about the stock market. How does a recession impact stock market investors? Well, there are definitely a lot of people out there who make a lot of money during recessions. They look to short, and they short stocks during times of economic downturn, and they do a lot of people do very well for themselves. Unfortunately, most of those people are much more educated and much more sophisticated than I am in terms of their investment into the stock market, and so they're able to kind of see the ups and the downs that requires a lot of education, a lot of time, and a lot of experience. The reality is that for me, it's a little bit too volatile because the risk is essentially infinite. I mean, there's no ceiling to how high a stock price can go. So if you short the wrong stock and it just continues to climb, I mean, you're at a loss until you eventually get out, right? So there's also real estate. Again, a lot of people make a lot of money in investing in real estate during recessions. Take 2008, 2010, for example. If you got in at the right time, 2009, 2010-ish, you could have done very, very well for yourself. Now, the reality is a lot of that is probably due to timing, and unfortunately, probably more than half of it was just more so due to luck than anything, because again, there's no magical number, there's no magical sequence that can pinpoint exactly when the bottom of the market is going to be versus the top. So it's really all about just coming in at the right time. And finally, commodities. Commodities are real, probably the most, out of all the asset classes, out of all the investments, are the most tied to economic conditions. When things are going well, commodities are in great demand as the economy is growing. And when things are going south, then obviously precious metals and alternative investments, make a lot of sense for people that are hedging against the downturn of the economy. So we're not there yet. We're not in a recession. Many people would consider apart from the news cycle of the past few weeks, that we're in a pretty healthy economy right now. So where are investors currently finding yield? Well, again, back to the stock market. People are definitely making money here. It's not our bread and butter. Again, the things that that we have trouble kind of reconciling against, like kind of from a risk perspective, is it's very volatile. Like we saw in the news cycle before. One day the Dow's up 700 points, the next day it's down 500. There's a lack of control there. In fact, there's kind of an interesting story. So Andrew Lanoy, the CEO of our company, before he got into real estate investment, he was actually in the entertainment industry. He worked for William Morris, which some of you may be familiar with. It's the largest talent agency in the country. And he had a great career there, represented a lot of big name actors, celebrities, musicians, and was, like many Americans pre-recession, a lot of what he was making, he was essentially blindly putting into a 401k, and boom, 2007 hit. The subprime crash happened, and as I'm sure many people remember, retirement savings that were locked into traditional stock market, a lot of them were crushed. But what happened even more so during that same time period that was an eye-opening moment to him is his parents had actually just retired down to South Florida. And when the subprime crash happened, almost overnight, they lost about 35% of their portfolio. So this was kind of the switch, that came on inside his head that was like, okay, how does a, upper middle class family that's seemingly done everything, quote unquote, the right way or by the book, they live within their means, they saved what they could, and here they were in a position that their entire retirement was in jeopardy with something that was completely out of their control. And finally, you've got some income generation. There are some benefits. Obviously, I would never discount the fact of having a portion of your portfolio allocated to traditional public equities. But if you're going to be investing in those, I would always recommend to my family and friends, invest in something that's got some dividends, right? I mean, we're all about creating those passive sources of income. And so if you're going to be investing in the stock market, we definitely like things that have the high dividend yield on them. Cryptocurrency. So this is, my generation is this is all the rage. Get in on Bitcoin. Everyone. It's funny. I think at the end of last year, everybody and their mother was a Bitcoin expert. Am I right? I mean, I can't tell you how many people I talked to that were like, you need to put all your money right now into Bitcoin. And so you start talking to them a little bit. Okay, well, what is Bitcoin? Oh, well, it's a decentralized currency. Okay, but what is it? Like, what's the underlying technology? What's the basis for the investment? Oh, it's blockchain. Okay, what's blockchain? And nobody has the full answer, it seems like. I'm sure that there may be even someone in this room here that is a Bitcoin expert, but I'm not. But what's funny is I also, I definitely fell headfirst into the fear of missing out, the popularity that was all, the rage, back in kind of November, December of last year. And what's funny is, I went in, I invested, and I made an absurdly good return for a 30 to 45 day investment. But the reality is it's just way too volatile. I mean, it's, up $1,000 one day, down $1,000 the next day. You've got government regulation, which you can never control or anticipate. That's, will fluctuate the price. And then again, there's very, in my opinion, there's very little awareness or understanding about what the real underlying benefits of the investment are when it comes to any cryptocurrency, let alone Bitcoin. And then finally, there's no income generation. You're purely at the mercy of the market. When it's up, you're up. When it's down, it's down. And I read stuff every single day about there's an impending crash that's going to take it back down to zero. So it's just for us, it's just something that is a little bit too risky. Commodities. So like I mentioned before, this is one of those investments that, I talked with investors every single day that are killing it in oil and gas. They've done excellent in precious metals. And the reality is that the returns are out there. But again, for us, it's much too dependent on the flow, kind of where the market cycle is. Commodities, apart from precious metals, are absolutely tied to economic growth. So if we are to go into a recession, the first thing that's going to slow down is your oil and gas. It's your commodities such as corn and wheat and traditional things like that. So for us, again, it just really doesn't make sense. Also, there's no income generation. It's an investment in a commodity, so you're not getting any sort of passive income, apart from if you're investing in oil and gas, and maybe you're seeing some royalties if you have equity in the underlying asset. So for us, again, that's also kind of a no-go. So what are, when we're looking at investments, when we're looking at, especially again, kind of during times of economic uncertainty, what are the things that we evaluate? How do we evaluate our investments? What are the things that we're looking for? We've come up with 5 main characteristics that we like to see in any sort of deal, any sort of investment that we're looking at. And so it starts with security, right? I mean, I think we can all agree that we want a well-securitized investment. So what does that mean? Well, for us, we like equity plays. The reason being is because equity, in my opinion, is one of the most secure assets that you can get, because if you have equity in the underlying asset, the chances of that, and we're talking about real estate here, obviously, the chance of that going to zero is pretty rare. So, you can invest in definitely other alternative assets that provide great sources of security, first position liens and UCC filings on companies. But for us, the most securitized investment is definitely equity in the actual asset. So secondly, you also want an asset that's in demand, right? So you don't want to go out and you probably wouldn't want to invest in a company that's making compact discs, because it's not something that people are buying right now. So for us, we like to find an asset that is out there, it's in hot demand, and that's where we like to kind of focus our efforts. Thirdly, you want an investment that's liquid, right? So you want something that, if something were to happen, a life event or some sort of change in that you needed to pull cash out immediately, that you had the availability to do that, or at least within a relatively short time frame. And finally, you want an investment that's undervalued, right? So this is kind of a no-brainer. So I think there's a quote from, I believe it was the CEO of Blackstone, who said that the only way to find a bargain or a deal in this life is for the expectation to be far lower than the reality, right? And so that makes sense. So if you want to find essentially a property or an investment that you're buying at a discount, that way when the economy grows, when things are looking good, that's how you're making money on your investment. So those are the first 4. Now, the most important characteristic that we've kind of highlighted on as being, when you're looking for the right investment, the right deal, is no better highlighted than this quote by the Oracle of Omaha himself. So if you don't find a way to make money while you sleep, you'll work until you die. And I don't think that, that is definitely a very true statement. So what are we looking for? We're looking for passive income generation, right? So I like to take notes from, and I like to see kind of what the people who really know what they're doing. So the big high net worth individuals, the billionaires out there, where are they putting their money, right? So I don't know if anyone's familiar with Tiger 21. They're a big, I guess, they consider themselves a social media network for high net worth individuals. It's basically an investment club for very, very wealthy individuals. And so this is a pie chart showcasing their investment allocation from Q1 2017 to the end of Q4 17. As you can see here, a significant chunk of their portfolio has been invested into real estate. And it's not any real estate. This is income generating assets. So they're not investing in like an equitable, single family, fix and flip, they're investing in multifamily, they're investing in mobile home parks, they're investing in rental properties that are generating income and producing a source of passive income for their investment members. So net worth millionaire versus income millionaire. This is actually, Andrew, our CEO, he's been on a couple podcasts, talking about this particular topic, and it's one that's very interesting. So if you think about, pre-2007, there was all this investment in real estate. A ton of people had, cash capital tied up in, multiple fix and flips, and, a lot of people had a lot of net worth, but it was purely based on an equity standpoint. Now, what happened when, the subprime crash happened, the housing market fell apart? Well, obviously, those people who were invested on the equity side of the business, they lost a ton of money because they didn't have any sort of income-producing assets that they were working with. It was all tied up in equity. So where we look at is, and it kind of, again, showcasing what Tiger 21 Club and, a lot of the other, very high net worth individuals out there are doing, is they're moving to income producing investments away from equitable investments at this point in time. I'm sure, a lot of people have seen this question. It's fairly common. So I always see the little blurbs come up. So what do 90% of millionaires what do they have in common? Well, they invest in real estate. So we'll get talking into a little bit about income producing assets within the real estate market. So one of the first things that we did as a company when we were founded 6 odd years ago is we looked at all the traditional spaces. So we love all the asset classes. I mean, Andrew came from single family. I myself have done some stuff in multifamily. Our COO and co-founder of the company has been investing in mobile home parks for over a decade. So we're very familiar. We love all the asset classes. But the reality is that we've reached a point in the United States today where a lot of the more traditional asset classes have kind of reached their apex, in our opinion. Multifamily, I mean, I don't know where you can find multifamily deals right now. Certainly not where I'm from, and I know a lot of friends who are heavily invested in this space. We were talking about it earlier. It's really, really hard to find properties that make sense for investors right now. I mean, cap rates are compressing across the country, which inevitably means lower returns. Single-family market is really no different. I mean, you can still find properties out there, but the reality is lending is very volatile. And one of the downsides to the single-family market is if you're vacant, if you got a single-family rental and you're vacant, you're 100% vacant, which is a layer of exposure that we're traditionally not very comfortable taking. And finally, you got retail. I mean, everyone's seen, what's been going on in retail space recently. I mean, the big box stores, you got Best Buy being overtaken, moving to solely on, almost solely online. You've got, Circuit City went out of business. All of these big retailers are being overtaken by Amazon. So, I don't know how much longer, the retail asset class will be around, but it's definitely, again, something that we see that, like I mentioned before, one of the things that we look for is assets and investments that are in demand, and it just seems like the demand is very quickly shrinking with that particular space. So you've got all the traditional asset classes here. It's definitely getting hard to find deals. So we're talking about real estate. So where do you put your money? Where do you invest? Well, for us, we chose mobile home parks. I could give an hour-long presentation on just the benefits of investing in mobile home parks. We love the asset class. Across all of our company, we probably, each member of the operations team has over a decade experience in the space. We're very comfortable with the space, and we love the asset class. So let's talk a little bit about some of the benefits, some of the pros for investing in mobile home parks. First and foremost it's probably one of the lowest cost per unit of any asset class in real estate. On average, it's dramatically shifted over the past 5 years, but right now, properties that we're acquiring, we're basically buying doors, or as we call them in mobile home park world, pads, for probably between $20,000 and $25,000 per pad. There's a lower cost for repairs and maintenance. So in the overall business model of mobile home park ownership and operations, the point that you eventually want to get to is you want to have 100% tenant-owned homes, meaning that essentially what you are is you're leasing the land. You're essentially a parking lot for the residents and their mobile home park, or their mobile homes. So in that regards, when you have a business model that's set up like that, when the residents all own their own units, when a resident has a leaky faucet or a broken toilet or any other major issue that can come across when you are a multifamily owner or even a single-family rental owner, they're not calling you or your maintenance guy to come out and fix those issues. They're responsible for their own upkeep of their property, which it does a lot for the overall, just the pride of ownership and the value for the community, but again, it also keeps your expense ratio down, and it's lower cost for repair and maintenance. So spreading out risk. Obviously, we all want to be diversified in any of our investments, and what's really great about mobile home parks is when you invest, it's great to invest into a portfolio where you've got multiple markets and multiple homes, but even in an individual mobile home park, it's not like a single-family renter where if you have to evict your resident, or they leave, or they default on they don't pay their rent on time, so you have to evict them. You're 100% vacant. With mobile home parks, because there's multiple sources of income from your lot rent and sometimes even home rent, your risk is diversified across the entire property. So finally, next would be high demand and low supply. So we really like this. This is a very intriguing aspect of the asset class. What's really unique about it is that if you look at today's kind of, again, economic landscape, and many people, whether or not you believe we're on the brink of a recession or not, I mean, we're in a pretty healthy economy today, but the numbers are pretty staggering. If you look at the average income in the U.S., it's just about $32,000 a year. So when you break that down into a housing allowance, it's about $650 a month. When you compare that to the cost of an average one-bedroom apartment in the United States, which is $1,000 a month, there's obviously a very wide discrepancy there. So we feel that we are in what we feel is already an affordable housing crisis in the United States today. Now, we know that there is an insatiable demand for affordable housing, but what's even more unique is that the supply of mobile home parks, on average, is actually shrinking, about 1% on a year-over-year basis. There's a couple factors at play there. It's primarily due to zoning regulations. A lot of municipalities around the country don't want parks to be built up next to their new single-family subdivision where homes are selling for $300,000. But there's also a cost barrier to entry as well, where from what we've seen in the last few years, the cost of infrastructure generally outweighs the increase or the investment of capital, unless you're building a 5-star $20 million property. And even there, most of the big public REITs are the only groups that are really developing properties out of the ground at this point. Next, less tenant turnover. So one of the really unique things about mobile home parks is I think the term mobile home is unfortunately kind of a misnomer, because on average it's about $8,000 to $10,000 to move one of the units out of the park. And so our residents, when they come in, when they actually have equity in the home, even a 10, 15, 20% increase in rent, lot rent, is not going to put them in a point where they're going to be able to pick up their home and move out of the community, purely because the challenge with a lot of these residents is for them coming up with a down payment on their home, let alone to come up with $8,000 to $10,000 to move their unit down the road to a cheaper community. And then finally, the last two are kind of hand in hand. So what we really love about the market is it's very fragmented. There's not a whole lot of industry data out there in terms of the overall makeup. But by anyone's best guess, between 50 and 70% of all the mobile home parks in the United States are actually owned by mom and pops. And so for us, that presents a great opportunity because it means that a lot of these properties are essentially legacy owned. So they've been passed down from generation to generation, which it leaves a lot of room for value add and a lot of room for going in and finding very undervalued, mismanaged properties. Back in late 2000s, there was, some of you may remember it, there was the chattel crisis. So a lot of very well stabilized mobile home parks, properties across the country, lost a significant portion of their residents because they got turned upside down in their mortgages, which they're not essentially mortgages; they're chattels on these actual mobile home units, and so a lot of those previous owners, in a lot of cases, because they had no debt on the property, because essentially these were properties that were essentially printing money, they had no incentive to go in and put in the capital as well as the labor to do infill in these properties. So up until a few years ago, you could go out, you could find a 80% occupied property in a Class A market and do the basic blocking and tackling of real estate, sub-meter out utilities, increase lot rents to market, and you could have got that property at a 10 cap and seen double-digit returns on your money all day long. Now, the reality is, as the more traditional asset classes have gotten more expensive, it's becoming harder to find yield. Deals are definitely getting harder to come by in this asset class, but we're definitely still finding properties that are worth taking a look at. Now, we've talked about a lot of the benefits of mobile home park investing, but kind of tie everything back in with the topic today. Probably the most compelling attribute of the asset class in general is the fact that most people consider mobile home parks to be one of the only recession-resistant asset classes within all of real estate. Self-storage is another one, but we're not the experts on that, and so we'll leave that for another meeting. What's really interesting is, so we've got this graph here. So underneath, you can see obviously the years, and then on the left, it represents NOI growth. From 2008 to 2010, during the last recession, mobile home parks were the only asset class in all of real estate that rose in both net operating income and in valuation, and you can see that highlighted a little bit better here. So, I mean, I'm sure everyone remembers, last recession, real estate was one of the hardest hit industries in the country, but mobile home parks, not only did they weather the storm, but recent data actually came to light that the top 5 operators in the space, all which have about 20,000 units under management, recorded record profits during that time. Now, there's probably a number of factors at play on why that's the case, but the primary factor behind that is a relatively simple concept, and that's the fact that anytime we see any sort of downturn, any sort of economic constriction, we also see an exponential increase in the demand for affordable housing. And so at the end of the day, that is the product, that is the service that we provide for our residents, is a safe, affordable place to live. So yeah, so now I'm going to open it up to questions. I'm sure there's some questions on mobile home parks and the asset class and anything we've talked about today. This is my information on here. If you want to get some more information on our company, feel free to shoot me over an email or give me a call. So we'll open up for questions.
You have a box over there.
Okay.
There's a question back there, actually behind you, Chris.
Oh, I have a question, believe it or not. Maybe my first question, but thank you for coming to the group. In the mobile home park space, are you seeing I guess, can you address if the 55 and over park seems to be a higher growth area due to just the baby boomers getting older, and also maybe address some of the risks as far as from an association, from potentially as a landlord or an owner of property, bad things potentially happening there, and how you could mitigate that. Thank you very much.
Yeah, absolutely. So great questions. First and foremost, 55 and older communities, that's not a space where we operate. We specifically focus on affordable housing. So the 55 and older, resort style communities, just like in multifamily or single family, you've got kind of a very wide spectrum of different classes of properties. In mobile home parks, we rate them in stars. So your 1-star properties are going to be your gravel roads with, rundown 60s and 70s mobile homes, all the way up to 5-star, which would be your 55 and older resort style communities. I think that, definitely so that's really, a lot of the public REITs are operating in that space. Sun Communities, ELS, they've got, massive portfolios around the country. Florida, California, the beach lifestyle that, most of the baby boomers, the people who are retiring are seeking out. And so absolutely, I think that they're doing very well. There's definitely a demand for that right now. My concern, and I think our company, why we don't like that space as much as the affordable housing, is because we don't know what happens in the event of the next recession. I mean, you can never, every recession's different from the previous one, and so we're unsure of what will happen. I mean, will a retiree who is paying probably, on average, they're probably about $500 lot rents, maybe another, $600 for the actual home. So they're paying $1,100 to live in a mobile home park resort. Are they going to, when things are constricting and they're going to have to be watching their retirement income, are they going to, up and leave because they can find a 1-bedroom or 2-bedroom apartment down the street for $800, $900 a month? I don't know the answer to that. But as of right now in today's economic environment, absolutely they're doing very well. There's a huge demand for them. Like I said, those are the only properties being developed out of the ground right now are the 55 and older resort style communities. Now the other question was with regards to risk and liability. Is that correct? Yeah. So. We as owner-operators, we take on the risk apart from our investors. The way that we have our funds are structured, the investors actually come in an LP position, so they're not at risk of any sort of liability or anything like that. But there are things that you have to keep into consideration, and so there's not only is there probably the biggest one would be what happens if catastrophic hurricane or tornado comes through and wipes out the entire property. Well, the reality is we protect ourselves from that as well. We have full coverage insurance on any one of our properties. Then you also have just the resident, which is probably there's a very negative stigma associated with, quote unquote trailer parks. And, people think of mobile home parks being, well, I wouldn't say everyone. A lot of people think of mobile home parks being you drive through in the evening, you're going to see drug dealers and prostitutes running rampant. But the reality is that, most of our communities are very clean. You go in at 5 o'clock in the evening driving through one of our properties, you're going to see people coming home from their 9-to-5 blue collar jobs. Maybe they work at Walmart, maybe they work at a gas station. There's going to be kids playing in the street, having been at school. I mean, we don't have to worry about as much as what you would, traditionally think. I mean, probably an even greater risk area would be, your lower class multifamily units would be, equivalent in terms of like a risk liability standpoint. But we protect both ourselves and our investors from that.
I got the mic.
Yeah, there you go.
I'll get you next. Is that okay?
Yeah.
So, hey, thank you, Brandon, for coming today. I was just wondering if you could dive in just a little bit to help us understand the structure of your funds. To invest as a limited partner, what level of accreditation do you have to have, number one? Number two, what is the returns look like? What is the holding period? Do you offer a preferred return on the initial investment, and also what is the buy-in threshold?
Yeah, great question. So the fund structure can differ depending on kind of the investment opportunity that you're looking for, as well as really your investment strategy. We've got a couple different models, all focused around the core business strategy of the acquisition and turnaround of value-add mobile home parks. So probably 90% of what we do are structured as 506C Reg D, meaning that they're reserved by the SEC for accredited investors. Excuse me. So if you're not familiar with the qualifications, there's either the income requirement, which is $200,000 for an individual, or $300,000 a year for someone who files jointly over a 2-year period. That's the income requirement. or the net worth requirement is $1 million of net worth, not including your primary residence. So when we're going through the verification process on those particular investments, you have to meet those standards. We have done some non-accredited funds in the past. It really just depends on if we find a deal that makes sense, what the raise is looking like, that sort of thing. But in terms of the returns, again, it really just depends on whether, what is your strategy? Like, are you looking for more something that's geared toward a fixed return, something set up more like structured like a debt offering where there's really no equity involved, where you can invest through, a self-directed IRA and not have to worry about UBIT implications? Or are you looking for something that's more so with an equity play where you've got that preferred return, the equity position in the property, and then obviously the back-end capital appreciation and growth, as well as tax benefits. So our lending funds, have paid out anywhere from on the low end 8% all the way up to 16% on a hold of capital of, on average, it's between 3 and 5 years. And then our equity investments pay out, on average, is probably about between an 8 and 10% preferred return, depending on whether it's a fund or an individual property. And then what's really a lot of syndications have kind of switched to the model of the infinite return, which I don't know if you're familiar with that, but basically it's a very compelling structure where it's usually between years 3 and 5 of the ownership of the property, we'll look to refinance the deal. And so we utilize the proceeds from that refinance to return 100% of the invested capital. So you're essentially cashed out, but the investors are still collecting an annualized return based on the equity position and then the cash flow split depending on how the deal is structured.
Have you guys went to that model?
We have, yep.
Okay. That's cool. How long have you guys been doing that now?
That particular model we've been running now for the first fund that we launched with that model was February of last year. Yep.
Last year. Okay.
Yep.
I talked to Andrew about this 2 years ago and they hadn't done it yet.
Yep.
So it's good to know.
Absolutely. Yeah.
That's a great model.
Absolutely. I mean, yeah. Well, you can pull your capital from the deal, play on house chips. It's a win-win scenario. Yeah. So, sorry. What you had one more other question? Was?
No, I think
Oh,
you
okay.
hit it for the most part.
Perfect.
Thank you so much.
Perfect. Yep.
Thank you for coming. I think one of my biggest challenges have been park-owned homes.
Mm-hmm.
We wind up with these, and some parks we've bought are all park-owned homes,
Oh, yeah.
sometimes even on weeklies or something like that. So we're always trying to transfer everything over to usually like a lease-to-own
Absolutely.
thing. We've tried to give some homes away. That usually, like I hear that all the time from like Dave Reynolds guys, and all that, but we usually wind up drawing in the worst of the worst with this free or $1 home or something
Yep.
like that. So we always want to lease purchase these homes. We used to do notes until the Dodd-Frank thing came, and now we do a very simple lease to own.
Yeah.
But until the tenant owns that home, we still are having quite a bit of turnover because it's just kind of a glorified rent, I guess.
Yep.
I'm trying to figure out a way to get that. I guess maybe I'll lower the monthly. How do you guys attack that?
Yeah, so great question. So the reality is that 5 years ago nobody wanted anything to do. Like you wouldn't even touch a property with park-owned homes. But based on kind of the market and what deals are available out there, they're almost like a necessary evil today.
Yeah.
We love park-owned homes because one of the really unique things about our group is we've actually have our own in-house construction group. So we don't have to rely on third-party contractors and whether or not they're reliable or not. We'll, within 30 days of us acquiring a property, we'll send contractors on the site to do any sort of like renovations and rehabs on those park-owned homes. So we'll in certain cases, we'll completely gut the units, put about $8,000 to $10,000 on average into each unit, and then we're able to turn around, remarket, and resell it to residents moving in for between $15,000 and $20,000. So it does two things. One, it's a pretty healthy profit margin on the actual flip of the unit, but also it provides a much needed level of affordability as new homes coming in are typically retailing between $30,000 and $50,000, and so when we find ourselves in markets where even at a $15,000 to $20,000 price tag, the residents are having challenge coming up with $2,000, $3,000, $4,000 for a down payment. What we'll actually do is we have rental conversion programs in place, and so what we'll do is you've got your lot rent separated from your home rent, and so essentially what we'll do is continue to keep on collecting lot rent as it is, but that home rent, a portion of that, it's generally over a year, 2 year period, whatever whatever however we build it out in the pro forma, but we'll keep back a portion of that home rent, set it aside into like a savings account essentially, till it reaches that $2,000 to $3,000 or whatever the down payment amount is, and then we'll actually utilize those funds that we've held back as the down payment, and then we've got a number of different financing partners, 21st Mortgage, Performing Equity Partners, some of the bigger guys, and they'll actually finance the residents into the home, and we'll go on their balance sheet. So
Does 21st Mortgage, do they want those to be newer homes?
I mean, they'll go older homes. They go by NADA value, and so typically they won't go below. I think the threshold might be as low as $10,000 now. Don't quote me on that, but it's definitely been brought down a little bit, and so it really just depends on what we've put into it. Because like I said, we're renovating a lot of the units before we're actually putting them into that rental conversion program.
Okay. Can I ask one more?
Yeah.
If we're trying to, I've had some issues with going into an area where lot rents are pretty low. And I know typically you want to go around and get your comps. Everybody's getting $250 and maybe this park's getting $175. But a lot of times when the comps that we're getting are all these mom and pop comps. So everybody in the area is $175 a month when you're feeling like you ought to be more like $300 or $350 or something like that. So
Yep.
Your competition is all really cheap too. We're always trying to shove these lot rents up some more. Do you have a strategy for that?
We definitely look at comps when it comes for other mobile home park operators in the markets when we are looking at lot rents, but more so what we look at than anything is apartment rents. I think that for us is where we feel is our biggest competitor. So I can't remember the exact number. I think if you take the lot rent and double it, that should be the equivalent to the cost of a one-bedroom apartment in the same market. And so that's traditionally where we're looking at. I mean, it's tough. I mean, if you're surrounded by mom and pops that are $100 on average lower on lot rent than you are, I mean, I think you're going to struggle. So maybe that would be a deal. We'd absolutely consider that in our due diligence process, and maybe we'd have a strategy where over time we feel like we could pick up a couple of those other properties at certain points and eventually bring them up to market. And so we could build out a pro forma that included that timeline of acquiring those additional properties. But yeah, I mean, I think that's just a challenging situation.
It's the question area here. Yeah. Hey, quick question. So I have a park, but how often are the park owners involved in the sale of new homes? Do you see that happening where you own the park and you have lots and you want people to come in that own their own homes? Do you just kind of let them do whatever and show up and then you just do the lot rent? Or are there programs for owners to get involved with the sale of the homes, to either partner with manufacturers of homes, or what do you see happening in that
So you're
area?
asking just about like filling vacant sites, like how we're bringing in new homes?
Yeah, like could I resell the homes to the buyers on the lots?
The existing like park-owned homes, you mean?
No, new homes, like bringing new homes to the lots. So you've got vacant lots
Right.
that you want to lease out.
Yep.
Do the owners of the property, the park owner, get involved in reselling those homes to the new tenants or new renters, I guess?
I guess if you're a smaller operator and you're kind of actively involved in the day-to-day operations, I mean, I absolutely, like if for my own mobile home park, I would absolutely be on site to help with the lease up and infill process. But for us, we rely on our community managers. I mean, we're a little over 2,000 spaces right now across 30 different communities. So we educate our community managers on the sales process. So we go through 21st Mortgage to bring in new homes traditionally, through the cash program. Are you familiar with the cash program? Okay, so 21st Mortgage, which is the largest lender in the space, they've got a really unique program. It started about 6 years ago now, and what it does is it allows operators, it's really more geared toward the smaller and mid-size operators who don't have, endless amount of capital, that they can go work with a manufacturer, spec out a unit, That home is then delivered on site. The entire setup cost and the purchase price of the home is then passed along to the end resident. You have about a 12-month period of no payment, no interest to be able to find a buyer for that house. So it's essentially a way that you can fill vacant sites in your community for basically coming out of pocket almost nothing, right? And so we'll utilize that process a lot. Now, like I said, we don't, probably like from like a day-to-day operations level, I mean, Andrew, myself, Mike, we're not getting involved on, each individual home sale. We rely on our community managers, and in certain markets, our sales managers to complete that infill and lease-up process. Does that answer your question?
Community manager is like a property manager? Is that
correct? Yeah. So at every one of our
okay.
locations, and I think that's a critical aspect, especially if you're doing multi-state or out-of-state operating, is you have to have someone on site, not only for lease up and infill perspective, but also for collections. I mean, that's the core of this asset class. I mean, you have to have someone who's willing to go beat down a door to collect lot rent if a resident's not paying. So
yeah, going back to the sale, I was just concerned that, like, let's say somebody wants to rent that lot, they go buy a home that, they go down the street and the guy sells it to them for $60,000, whereas I could have gotten a deal on it for $30,000, so they have more cash flow to pay me lot rent versus them, being at the top end of their income level. So that's all what I was concerned about.
No, that makes a lot of sense. Yeah, but the reality is, I mean, at the end of the day, if a space can get filled and we don't have to do anything, we love that. So we definitely have relationships with retailers, local retailers, the shop or the stores on the side of the road that are selling the manufactured homes, to where, we love for them to bring in a unit, fill a space, and essentially we don't have to do anything. So.
Isn't Warren Buffett involved in either 21st Century Mortgage or Clayton Homes?
Both.
He's involved in both.
Yeah,
I thought he was.
Mm-hmm, yeah, so Warren Buffett owns Clayton, which is underneath the Clayton umbrella is 21st Mortgage. So he's a smart man. I mean, he's got it's a completely vertically integrated organization. They do everything from the manufacturing, then you've got the financing arm, both retail and commercial to mobile home park operators. So yeah, it's a good gig.
Thanks, Brandon, and thanks, guys, for letting me share the boombox here so I can ask some questions. Thanks. Now, as a lender, we see lending on leasings all the time. They're just they're literally ATMs. I guess from the investor standpoint, I put my investor hat on. I always think about what's going to happen if. So in your model versus where you own the dirt around the lots. So the question I was thinking of is, you go to these tenant-owned homes. How do you pre-qualify those people as far as the ability to pay that lot rent? And then what's your recourse if they don't pay lot rent? That's almost like HOA dues. I mean, so what if you slap a lien on them? It's Joe Lunchbox, so they're just going to laugh you off, and you can't move their home because they own the home. What's your recourse if they don't pay the lot rent?
Yeah, so with a lot of the new homes, that's a great question. With a lot of the new homes that are coming in through the cash program, there is recourse. There are recourse loans, and we as the owner operator are liable for that. Now the reality is, 21st Mortgage, they have, I think it's $8 billion in outstanding mortgage notes on specifically mobile home parks right now. They have a 5% default rate. So it is very, very low than what you would traditionally think of being a mobile home park, and what delinquency would be. But it is something that we have to concern ourselves. And like, for example, there was a property that we bought in Dothan, Alabama, in Sierra Mobile Home Park. And we went in there, we started operating the property, and about halfway through the year, we realized that 50% of the residents continued to fall behind on rent, and with us owning a lot of the newer homes coming in there was of concern for us. So we eventually just had to evict the residents. And so that's one thing that you have kind of in your back pocket is. There are certain states, obviously, it's very challenging to do that, like California, New York, New Jersey, but we operate in states that are very, landlord-friendly and have laws that can protect us in that way. And so, if there are issues with payment of lot rent or, they're defaulting on their mortgage, we're more than likely going to get them out of the home. And whether that's, remarketing and reselling the home or, there's a number of factors that could happen.
So if they default on their lot rent, first lien position on the title of the home. Okay. So
Yep. Yep.
Okay, I got one more, and then I'll pass the box. Okay.
I think there's some questions up there. So
Okay,
yeah.
and I'll pass it right in
Yep.
1 second.
Yep.
Let me just ask you this. How hard is it for you guys to get enough mobile home parks to create a tranche that you would create a fund out of? I mean, how many parks do you usually place into a fund? Is it just one, or is it 2, 3, 4, 5? And do you know, how hard is it to get that ready to go?
Yeah, great question. So right now, in our current portfolio for the fund that we've been operating since February of last year, there are 17 properties in the fund. Right now, we're actually under contract for 3 properties down in Gulf Shores, Alabama. And so we can do a tranche or a raise with one property under contract, because typically, our acquisition criteria are starts with three pieces. So first and foremost, we like properties that are around 100 spaces or more. That's kind of our bread and butter. We like 50 to 70% occupancy, because our core competency is the infill and lease up of value add mobile home parks. So we like enough opportunity to where it makes sense for both. It makes it worthwhile for both us and our investors. But we don't like a turnaround that will take 7 years, like going out and getting a 20% occupied park. And then finally, we like properties that are trading between 8 and 12 cap rates. At that kind of, 3 pieces of criteria, generally the average purchase price is going to be, between $1 and $5 million. And so if we got one property under contract, then we'll go out and do a raise. We'll just open up a tranche in that fund for $1 million, and then plus whatever capital needs are needed for the project. And so that's kind of how we operate. I mean, we're not out raising capital unless we have deals under contract, because we don't want to go out next month and raise $10 million and not be able to deploy it, because then it doesn't make sense for us or our investors.
Back to if what I believe Billy was talking about, is there like a foreclosure that you have to go through to transfer the title from the homeowner to you guys as a park owner? Or even though, I know you're in first lien position then, but is there a foreclosure process, or how does that look?
Yes. So on the mortgage side, there is. So essentially what happens is that, so first and foremost, there's an eviction process to evict the resident from the home. And then essentially what would happen, like on the 21st side of thing, again, because that's the most traditional way that we'll bring in new homes with, when 21st brings on a new home to kind of put on their balance sheet under this cash program, if a resident is evicted, they don't come to us the next day and say, okay, you have $15,000 outstanding on this principal, you need to cut us a check for $15,000. Essentially what they do is they convert it back into essentially it's a monthly payment or a monthly mortgage note to us as the operator. So we take back ownership of the home, and then we're just making monthly payments on it instead of having to stroke a check for $15,000. Okay. Does that make sense?
Yeah, but there's no, you don't have to go through court with the county or anything like that.
Not on our end. Yeah, on for 21st, handles a lot of that, through their side of things. But for us, it's simple as the eviction process. Yeah.
What interest rates are you seeing on those type of home loans?
They can range anywhere from, average is probably about 12%, but they can range from as low as, I've seen as low as 7% with someone who's coming in with fantastic credit and good down payment, all the way up to 14%.
So not to go back to previous questions, but if 50 to 75% of the homes are already owned or financed some other way when you get there, what happens if those people don't pay their lot rent? So you don't have 21st Century, you have, they're with some other bank or something, or they own it outright. Then what do you do if they don't? What's the recourse there?
Yeah,
That's half or more of your
I
lots.
think it just depends on the lender, right, and what they're wanting to do. So we don't want to see homes leave the park, because if we filled a vacant site, it does us no good to, even if it's an unoccupied home, we don't want to see it leave the park. So some lenders will work with us and let us just basically take over the mortgage and start making monthly payments on them. Others would probably come in and say, no, there's a $20,000 principal balance. We need you to come out of like we need that paid right away. So I think it just depends on the lender.
It's more not if they're not making their house payment. What if they're not making? They own the home outright or have some other lender, and they're not making their.
If they're not making
lot
their lot rent, we'll evict them from the home. Yeah, that.
Even if they own it outright.
Mm-hmm.
Interesting.
Yeah.
Okay.
Yeah.
Cool. And I think Tom had asked a question earlier that I didn't catch the answer to. What's the entry level for your investors?
So typical minimums are $100,000. On our non-accredited opportunities, we've done $50,000 minimums. And then in some certain cases, we've done some like other lending funds, which are like more structured like a debt offering that has gone as low as 25, but that's traditionally the lowest. And I don't think we have any opportunities currently that are at that minimum.
I do have a question. If somebody wants to be able to get on an email list or anything like that, just email you, because I know that I've been getting you guys' emails for years, and I love it. Just always keeping track what you guys are doing, what new offering you have. So what's the best way to do that so that they don't miss a deal?
Investors at fourpeakspartners.com, or you can go on fourpeakspartners.com and fill out our investor questionnaire. Either way, you'll opt in to receiving information not only about our upcoming opportunities and deals, but also Andrew, our CEO, he basically it's once every couple weeks he'll send out an email blast just talking about the asset class or just investing in general. A lot of really good information, and I mean he's a wealth of knowledge. I mean he's been doing it for over a decade. So.
Awesome. We have one down there, one down there. Anybody else up here before I move down there? No? Sorry, with a hat? No? Thank you.
I may have missed this, but what markets around the U.S. Are you guys particularly interested in, and is there any places you're staying away from? And then when it comes to markets, are you generally looking in secondary and tertiary, or yeah? So where are you interested in, or what parts of the country are hot or growing in the right ways, so to speak?
Yeah, no, great question. So we are primarily located in the Midwest and the Southeast in secondary and tertiary markets. Right now we've got about 30 communities in our portfolio, spread out about 13 different states. So we're in Indiana, Michigan, Illinois, Ohio, down through the Southeast corridor. We've got a couple of properties in North Carolina, Tennessee, a couple down in Alabama. And so that's our core. We feel very comfortable in those markets. We love to find properties where we have other properties located in that same market because we've already done the due diligence. We already understand the market. We're not opposed to looking anywhere in the country because we do have our own in-house national management company, so we can operate anywhere. But where we've just struggled traditionally to find deals have been like coastal markets like Florida, California, coastal Oregon, areas where land tends to be expensive. Deals don't pencil out for us, as well as you deal with the added risk of the hurricanes and things like that. So
Over here. We got two more questions.
I actually had just kind of a comment, and it was referring to what a couple people were asking, and I thought maybe this could clear up a little bit. On the homes, the mobile homes where there is no mortgage, there is no 21st mortgage, they're only paying lot rent.
Correct.
They quit paying lot rent. Mm-hmm. You have to go through the eviction thing. For us, we have about 75 mobile homes. And I'm not saying that this is never going to happen, but we have never had to really go through an eviction process with tenant-owned homes, because if those people want to move out, they usually sell their home to somebody else on Craigslist. Yep. We approve them or we don't approve them, and then we don't miss a beat. We literally get every month's lot rent, and we don't even skip a second. If we have somebody that just doesn't pay and we're on them about eviction, they're usually, again, trying to sell it to somebody else or asking us if we want to buy it. And we might buy this home for nothing, $500, or we might buy it for $5,000, but we never really have to go through because these people don't have any money.
Absolutely.
So that we're like, hey, we'll give you $3,000 for your home, and we're usually there the same day with cash.
Yeah, no, that's a great point. More so than anything, what we have to worry about, and I'm sure it's probably a similar situation, is like if someone is mad that they're being threatened with eviction, so they'll go in and beat a bunch of holes in the wall, and then that's when you have to go in and remarket and rehab and restructure the home. So.
All right, guys, let's put it together one more time from Brandon. Thank you so much.
Hey, thanks for learning with us today on the show.
We would love to meet you at one of our free monthly meetups in Middle Tennessee.
Hit the thumbs up button if you like the content. Make sure you hit subscribe so you don't miss a thing on this channel.
Check out another awesome investing video here.